So let's talk about interest and dividends. First, let me explain briefly what the two are. Interest, you probably already know, it's money a bank pays you for putting your deposits into their bank. Years ago, the interest rate was a good interest rate. You could earn a decent amount of money by just having some money sitting in a bank somewhere. Nowadays, the interest rates have dropped down to ridiculously low amounts, and so it's almost not beneficial to put your money in the bank anymore because they're not paying anything. Most savings accounts are below 1% these days. In days gone by, you could have earned 5% on a savings account, and it was a legitimate way to earn some good revenue on your investments. So interest comes from a bank. Now, they oftentimes will pay you some sort of a benefit to open an account with them. You know, and you may have heard in the old days where they'd give you a free toaster for opening a bank account. Nowadays, they'll often give you, you know, a $20 bonus or $50 or whatever. That is also considered interest, and is, of course, is taxable interest or taxable income to you. So if you open up a new bank account and they give you $100 with your first direct deposit or whatever it is, you're going to pay tax on that $100 because it's interest. The other way to earn a little money on your investments is dividends. And dividends are paid by corporations. Whenever corporations have had a good year, they will often declare a dividend and give it out to their shareholders. Now remember, we talked about this in chapter 1, there are millions and millions of shareholders for most big publicly traded companies. So a company often reports dividends as per share amounts. And a lot of times it sounds like a ridiculous amount, like 20 cents. They're going to declare a 20-cent dividend. Well, that means everybody who has one share of stock will get 20 cents. Now, most people own way more than one share of stock. The common amount to purchase is what they call a lot, 100 shares lot. So anybody owning 100 shares of this would get $20 because they get 20 cents per share. So 20 cents times 100 is $20. They're going to get $20 for just owning the stock of that corporation. Dividends are often declared and paid quarterly. That is a very common time frame to pay dividends, is quarterly. And so a lot of people will invest money in stocks that have a track record of paying pretty good dividends. Procter & Gamble is a pretty good one that pays dividends. GE, some of the utility stocks, they pay really good dividends, so they'll invest all their money and live off these dividends. And of course, that's taxable income to you. There's a couple of things to keep in mind about dividends. They have the date of declaration, which is the date that they're going to declare the dividend, and the date of record. And that's just the date they look at the records and see who owns all the stock. Because if you watch the stock market, you know, there's millions of shares traded every day. So at some point in time, the company has to say, here's the date we're going to pay everybody a dividend. And so that's their date of record. So they'll say, we're going to pay a dividend on July 5th for everybody who owns shares on July 1st. So July 1st is their date of record. July 5th is their date of payment. So let's take a closer look at some of these. Okay, so looking at interest and dividends, generally it's taxable. The one thing I didn't mention a while ago is municipal bonds pay interest, and the municipal bonds are not taxable. And we're going to look at that here in a minute on how we calculate some of that. Gifts to open up the account are taxable. This is a pretty common item, the $100 for opening up an account. It is taxable as interest. And if you have more than $1,500 of interest, now this could be from one bank or it could be from 50 banks, it doesn't matter. If you have more than $1,500 of interest and dividends in 1 year, you must file a Schedule B instead of just listing the total. So, you know, we see this quite frequently, and it's not uncommon to list it all out separately. But if you only have about $1,000 of interest and dividends, then you just list it on the front of the Form 1040. But once you go over $1,500, then you attach a Schedule B. And a Schedule B is not a complicated form. Basically, all you do now is list out every bank and how much interest they paid you. So you might say First United, $200, Durant Bank and Trust, $500. You might have Exxon dividends, and you might list that out as $1,000. And so that's all you do. There's two sections on it. The top part lists your interest, and the bottom part lists your dividends. So this is a Schedule B. Pretty simple form. There's two parts to it. Part one is for your interest, and here you would just list out the bank name and how much interest they paid. You would use as many lines as you need to, and if you want it out, you can attach a separate schedule to it. There's also a place to put the interest you've earned on your Series EE and savings bonds. If you use that interest for educational purposes, it's excludable from your taxable income. And so that's why we can list it here. And then down here, we list our dividends. Here you list what corporation paid you the dividend and how much dividends they paid you. Now, you only have to fill this form out if you have more than $1,500 of interest in dividends. There's nothing wrong with filling it out if you have less than that. A lot of people will list it out their banks that paid them the interest so that next year they have a good idea of who they probably should report this year. So this is your Schedule B, pretty simple form. And like I tell most of my clients, we fill one out if they have more than one account, just so we can have an idea. Because you will be amazed at the number of times my clients will call me up and say, who all do I have to report the interest from? And it's not that they're hiding it, they don't remember which banks they have their interest from. And so by listing it out, we were able to tell them, well, you have these 4 banks, so make sure you get a 1099 from those banks. Interest on savings bond can be a unique item. Savings bond, and I think we talk about this later on, but savings bonds are often bought at less than face value. And then the difference between face value and what you actually paid for it is reported as interest. And you can either report that interest when you cash in that savings bond or every year. So if you buy a $100 savings bond, quite frequently you'll only pay $50 for that savings bond. And you can report the interest as $10 each year, or you can wait for 5 years and cash it in for $100 and just report $50 of interest income that year. Most people just report it whenever they cash it in. It's easier that way. So we also have this concept of qualified dividends. It's relatively new. It's only been around for a few years now. So we've already talked about how dividends are paid from the earnings of the corporation. And generally, your dividends are taxed as ordinary income unless they are qualified dividends. And so what makes qualified dividends? Well, if you held the stock for 60 days and it's a U.S. corporation, then you have earned qualified dividends. And the qualified dividends are taxed at what we call the long-term capital gains rate. And that makes a huge difference because your ordinary rates are much higher than your long-term capital gains rate. And right here, and I believe these are the tax tables for 2018, so these numbers have gone up a little bit for the last couple of years. If you were married filing jointly and you have less than $75,000, your long-term capital gain rate is 0. So you will pay 0 taxes on your qualified dividends as long as you're below this threshold. But then you can also see as you go across those thresholds, the ordinary tax rates are much higher than the long-term capital gains rate. So that's why having qualified dividends matters. It will save you taxes in the long run. And 60 days really is not a very long time to hold the stock to qualify for the qualified dividends. One other thing we want to talk about when we're looking at interest is municipal bonds. Municipal bonds we've talked about is tax-free income. And as such, when you buy a municipal bond, they will often pay a lower interest rate than what's available out in the marketplace. And so now you need to be able to compare 2 investments to see which one is the better one, because the municipal bond is offering you a lower rate of return on your investment, but it's tax-free money, whereas a corporate bond is offering you a higher rate of return, but it's going to be taxable. And in case you don't understand what a bond is, again, it's a lot like an annuity. It's just a financial agreement between you and somebody, a corporation, a city, a state, a school, a railroad company. Any of these things can sell a bond. It's just a contractual obligation between you and the company to do certain things. Generally, you buy a bond in amounts of $1,000 or $5,000. And in exchange for that, they are going to pay you interest. Bonds often have a maturity date and a rate of interest declared on them. And bonds often go for 30 years. So you can buy in the same issue, we can buy a bond that might mature in 1 year up to 30 years. It just depends. And you know it when you buy it. It's not a surprise that, oh, my bond don't mature for 20 years. You know what you're getting. And so you can use that information to buy an investment that will fit your needs. If you don't need any money for 20 years, you might want to buy some of the longer term bonds. Some of the risks you get with that is the longer term bonds will often pay higher interest rate, but of course now you don't know what's going to go on in between now and 30 years from now. Interest rates might skyrocket, and that 4% that you thought was amazing now is nothing when the market is paying 12%. So that's some of the risks you have to take. But to be able to compare bonds to one another, we have to calculate our after-tax return on investment, ROI. And so that will allow you to compare a non-taxable municipal bond to a taxable corporate bond. So you might buy some City of Denison bonds that are offering a certain interest rate that are tax-free bonds compared to some bonds from Google, which will pay you a higher interest rate, but it's taxable to you. So how can we compare those two? Well, we have an easy formula that we can look at. We start with our pre-tax rate, and that's whatever rate the bond is going to offer, and we multiply it by 1 times our tax rate. So you might be able to get a bond, a 3% tax-free bond, and you're in the 15% tax bracket, so you take 3% times 1 minus 15% and come up with the answer. And we're going to look at a solution here. So let's say you are in the 22% tax bracket. You can buy a taxable corporate bond that will return 5.75%, or a municipal bond which will pay 3.5%. Which is better? Well, this is where we need to calculate our after-tax rate of return on investment so we know which one is better. So we'll start with we have the numbers we need. We have a pre-tax rate of 5.75 and a tax rate of 22%. So our after-tax return on investment, 5.75% times 1.22 gives us this, or 4.49%. So now we can tell that our after-tax return on investment for this bond paying 5.75 is 4.49%. So now we can compare that to the 3.5%, and we can determine that 4.49 is greater than the 3.5%. So the corporate bond is better, from a pure tax point of view. So now there might be some other reasons why you might want to buy a municipal bond versus a corporate bond, but from just looking at a tax point of view, the corporate bond in this instance would be better. So bonds are a great investment. A lot of people buy them for various reasons. If you buy city bonds or state bonds, those are generally very safe. And some people buy them for nostalgia reasons. School districts are very popular for bonds. So even Grayson County College will sell bonds. So people will buy bonds from their alma mater or their local high school or whatever just to support the school. You'll see about those in the news all the time. When they want to build a new school or new building, they will often issue a large bond issue for millions and millions of dollars, and people buy them in $1,000 blocks or $5,000 blocks, and you can buy as many as you want and then wait for them to mature and collect your interest. Now, bonds will pay you interest normally what they call semi-annually. So every 6 months you'll get a payment from those bonds. And that's how retired people will use bonds to help support them in the retirement, is they're getting a steady stream of income, and they'll often buy the 30-year bond, so they know for the next 30 years they're going to get $500 every 6 months or whatever it is to support them in retirement.